Hello, everybody. This is Hungry for Moat with Avinash and Prabhat. We are doing Buffett's letters from his partnership years. That's before Berkshire Hathaway was under his umbrella. I don't think he had put any money in that company yet. He will soon, though. He will soon. So we last video was about the year 1960, and he had been doing annual letters. I think he's switching the strategy and doing 6 month letters now, every 6 months. We'll see how he does. We haven't read these letters, so we are actually reading them as we're going. Our last letter was written in January 61, and it kind of covered a lot of what happened in 1960s. 60, and this one is also labeled 1960 letter, but written in July of 1961.
Yep.
And last one was amazing. I mean, he talked about this map company that he bought, had an incredible investment portfolio, and
Yep.
he made like 50% from it. I mean, and he bets like 35% of his portfolio on this.
Yeah.
That's his money and all of his friends and family, everybody, 35%. I mean,
Yeah. And what's incredible about this mapping company is that they used to have a moat, and when Buffett bought it, they no longer had a moat, but they had this side investment fund, where that grew that still is growing higher than their core business. So, kind of a good lesson in capital allocation. Um, and
absolutely.
and this week, hopefully, we'll find out what he's up to with that company, and we can dive right in.
All right. Okay, here we go. To my partners. In the past, partners have commented that a once a year letter was a long time between drinks and that a semi annual letter would be a good idea. It really shouldn't be too difficult to find something to say twice a year. At least it isn't this year. Hence, this letter, which will be continued in future years. Oh
Nice.
my God. Look at
We
this.
called it.
Oh, I should
Perfect.
have asked for $1 million. Damn it. Uh, during the first half of 1961, the overall gain of the Dow Jones Industrial Average was about 13%, including dividends. Although this is a type of period when we should have the most difficulty in exceeding the standard, all partnerships that operate throughout the 6 months did moderately better than the average. Partnerships formed during 1961 either equaled or exceeded results of the average from the time of formation, depending primarily on how long they were in operation. Oh my God, I don't know what to say. This dude is just ridiculous.
Yeah.
So again, he beats the market on a bullish year, and there's so much volatility. Like year to year, markets up 13 to
Yep.
30%, and then it's down 10%, and then up again. I mean,
Yeah.
that's way too much volatility.
Yeah. And we still don't really know, since it's a private partnership, we don't know all the holdings that he has, but we know he has a substantial chunk in this mapping company. And did he get into investments already? I forget. I
No,
mean,
he's. I
in
mean,
insurance, sorry.
he has. I mean, no, that he buys some. Not to spoil anything, but he buys insurance companies later in his
Later.
life.
Yes.
Yeah,
Yes. But
and I'm
at
just
this
gonna leave
very
it at that.
moment, no. Right? Yeah.
Yeah,
Okay.
nothing as. Yeah, right
Okay.
now he's just picking stocks. He's not buying businesses to hold.
Yep.
He's buying and selling.
Yep.
And yeah, so this letter is actually first half of 1961. So I think the label up top at 1960 letter is appropriate.
Yeah.
All right. It looks like market's up 13% so far, and he has already beaten it. Okay, next para. Let me, however, emphasize 2 points. First, 1 year is too far short a period to form any kind of an opinion as to investment performance, and measurements based upon 6 months become even more unreliable. One factor that has caused some reluctance on my part to write semi-annual letter is the fear that partners may begin to think in terms of short-term performance, which can be most misleading. My own thinking is too much more geared to 5 year performance, preferably with tests of relative results in both strong and weak markets.
Interesting.
This, yeah. I mean, right,
Well,
nothing new here, though. Yeah, go
oh,
ahead.
yeah, I was going to say, even the 5 year is pretty short for Buffett because now we think of Buffett as like a buy one time, hold forever kind of guy, but you can kind of see facets of his cigarette butt type of philosophy here, right? 5 years is the time where the market's going to realize what the real potential of the stock is, and by that time I'll sell out. So yeah, something to keep in mind.
Yeah, yeah. The second point I want everyone to understand is that if we continue in a market which advances at the pace of the first half of 1961, not only do I doubt that will continue to exceed the results of the Dow Jones, but it is very likely that our performance will fall behind the average. Yeah, I'm saying he's thinking market is way too bullish, and no, no, we can never keep up if this continues. How am I ever gonna make any money?
Yeah. And also
Blah
the
blah.
disclosure where he's like, look, this we just got lucky here, hot hand, don't think that we'll still knock it out of the park in the future coming years.
It makes me think everybody lies. Everybody who's preaching on the internet lies.
Yeah.
People who are shitty lie about how they're good, and people who are good lie about how lucky they are.
Yeah.
You know, so just like just give our money to all the hedge fund people who are like, I don't know what I'm doing. In that case, give your money to me because I really don't know what I'm doing.
We're so geared for this.
Yeah, it's perfect, and you'll never see me again. Okay, our holdings, which I always believe to be on the conservative side compared to general portfolios, tend to grow more conservative as the market level rises. At all times, I attempt to have a portion of our portfolio in securities, at least partially insulated from the behavior of the market, and this portion should increase as the market rises. However, appetizing results for even the amateur cook, and perhaps particularly the amateur. We find that more of our portfolio is not on the stove. Okay. You have any comments
Okay.
about this?
Let me see. So, um, so to be on the conservative side compared to general portfolios tend to grow more conservatively in the
I mean, he's
general
saying,
portfolio.
yeah, he doesn't do, aggressive high tech growth stocks. So he does kind of conservative stocks, um, and that's just his style. And these should grow slower than the market. And then he likes to have at least portion of his portfolio in securities that are somehow shielded from the big macro market trends.
Hmm.
And partly does that by finding small illiquid stocks.
Okay.
And he's saying that this portion should increase the market. And so overall, this is shielded from market behavior and Mr. Market's erratic issues.
Hmm.
But as the market goes up, it should go up. Um, um, I don't know for
Yeah.
why that would happen, but maybe that just means it's a market for a healthier economy and more trade and GDP growth that everybody gets
Hmm.
rich off of.
Yeah. I kind of don't get the analogy with the cook, do you?
That's why I'm like, is it like something
Yeah.
that was famous in the 60s? Confused me.
Yeah.
However, appetizing results for even the amateur cook, and perhaps particularly the amateur, we find that more of our portfolio is not on the stove.
Okay, I think what this really means is like, hey, look, the stuff that we have in our portfolio is not heating up. It's not going up drastically here. It'll come a time where they'll blow up. Maybe it's not now. Maybe is that right?
I think he's saying like there is a portion of the portfolio that the formula is working in, but he thinks he can better allocate a lot of his portfolio and put it on the stove so that it cooks better.
Anyway, okay.
I don't know.
Yeah.
Ignore it.
Yeah.
Buffett, it's stupid. What a stupid dude.
He's 31 now?
Yeah, boomer. What a boomer. We have also begun open market acquisitions of a potentially major commitment, which I, of course, hope does nothing market wise for at least a year. Such a commitment may be a deterrent to short range performance, but it gives strong promise of superior results over a several year period combined with substantial defensive characteristics. So
Okay.
they start buying something off the open market.
I think that's what he's hinting to here. So he's saying, you know, they've begun acquisitions of major proportions, but um, they shouldn't see any results for at least a year. So that
Yeah,
means
like it shouldn't
that
move. It shouldn't
it's
move any.
right, and that means it's undervalued right now because that's when he bought it. So he shouldn't. The market should take some time to realize these gains. I think that's what he's saying.
Uh-huh.
Yep.
Progress has been made towards combining all partners at year end. I have talked to all partners joining during this past year or so about this goal and have gone over the plans with representative partners of all earlier partnerships. Some of the provisions will be a merger of all partnerships based on market value at year end, with the provisions for proper allocation among partners for future tax liabilities due to unrealized gains at year end. The merger itself will be tax free and will result in no acceleration of realization of profits. And the second part, division of profits between the limited partners and general partner, with the first 6% per year to partners based upon beginning capital at market, and any access divided one fourth to the general partner and three fourths to all partners, proportion to their capital. Any deficiencies in earnings below the 6% would be carried forward against future earnings and would not be carried back. Presently, there are three profit arrangements which have been optional to incoming partners.
Interesting. So this is how he's breaking down the current partnerships. So remember how he has, I think, like, is it seven different partners or six different partners? Yeah, I think it's
Yep,
six,
yep,
right?
seven.
Yeah,
You know,
seven.
six,
Okay.
yes, yeah.
So he's got these different partners, and so he's saying, look, based off of this, I'm going to make some changes to the partnership. Um, Based off of interest, this is how much um, these different partnerships will get based off of how much they put in. So I think this is just kind of structural changes in partnership and allocation of gains to the partners. Is that fair? I don't know if there's anything of high value here.
Yeah, but I mean, it is basically combining and saying, what they're going to do going forward. And the big takeaway is, I mean, his incentive structure. I think he's doing these three things here.
Mm-hmm.
He's saying, I mean, you could pick one or three. I can guarantee the first is kind of what we're used to. Like if you're doing up to six, he's not going to take anything till 6% threshold is reached, and then afterwards he's going to actually take a third. I think Buffett is the general partner here. He gets a third of each profit above 6%,
Oh, okay.
and the
Uh-huh.
limited partners get two-thirds. And if you do the 4% threshold, then you get more of a stake of the profits above it. You get three-fourths, and Buffett only gets a 1/4%. And if you
Mm-hmm.
say, I don't, even if you have a 2% profit, you can take, that they're fine. They don't have a minimum record threshold.
Mm-hmm.
Then anything that's profitable, that they get, a normal person get a fifth, sixth. So that's a bigger
Yeah.
uh, direct profit to the investor, and Buffett only gets one sixth. So it's like pick
Yeah.
whatever which one you want.
Okay. Actually, this is kind of important because what this suggests is that if you believe in Buffett, then even in downturn, you know, when you're technically not meant to be doing that well, when it's a hot market and you're having a bad year, or Buffett is saying that you'll have a bad year if you stick with him. It might go under 6%, but then you get to hold more of that money. So that's kind of interesting, even though you're not guaranteed that 6%. So I guess before, correct me if I'm wrong, correct before he said 6%. After that, I'll get to keep 1/3 of the or 25%. You said, right? So then
Well,
after,
one third will be a 33%.
okay, 33%. So I get to keep 33%, and then you get to keep the rest. But now he's giving the option for the limited partners to say, look, you guys can go lower and you get more of the share if you believe in me. So this is kind of
Yeah, so
like
I mean the bottom one will be like if you actually bought a stock of the company, and you are more in the boat. Things go good, you get a direct stronger benefit, and there's less of a downside protection. And the
yep,
number one will be, well, you're more careful. You still don't believe this 30-year-old dude knows what
yep,
he's doing, and
right,
and you don't want to share the access. You don't think he's going to be doing 50% every year. If you think he's going to be doing 50% every year, then you want the last option.
yep,
If you think he's barely going to do above 6% every year, then you want the first option.
yep, that's right. Yep, gotcha.
Um, in the event of profits, the new division will obviously have to be better for limited partners than the first two arrangements.
Yeah,
Regarding the third, the new arrangement will be superior up to 18% per year, but above this rate, the limited partners would do better under the present agreement. About 80% of total partnership assets have selected the first two arrangements, and I'm hopeful should be average better than 18% yearly partners presently under the third, and it will not feel shortchanged under the new agreement.
so the majority of the people are doing option number one, and then
It too.
about option number two. Oh yeah, the first two.
What
Okay,
it too?
one and two, and then about 20% or 18% are doing none. Um, okay, that kind of makes sense. The funny thing here is, I mean, knowing Buffett now, we would opt to the 18%, but
You know what he's saying though? He's saying up to 18%.
mhm.
The third one is gonna do better, up to 18% per year. And if you go higher than 18% return, then the limited partners would do better under the current. So under maybe the first. So is that true? Like if you have 18%, I guess the math problem, you're getting distracted a little bit. Like the higher the return,
The more you'll get to keep, right?
if you're in the third one.
Yeah,
Oh, I'm maybe missing something there. Doesn't matter.
yeah, yeah.
Okay, see. In the event of losses, there will be no carryback against amounts previously credited to me as general partner. Um, oh, they're saying if there are losses, you're not gonna like
Yeah.
there'll be no carryback against amounts. So like don't take money away
Don't
from me,
take
okay?
my money. Yeah. You
Yeah.
just lost it. You lost
Although
it.
there will be carry forward against future access earnings, however, my wife and I will have the largest single investment in the new partnership. Probably about one-sixth of total partnership assets, and thereby a greater dollar stake in losses than any other partner or family group. I'm inserting a provision in the partnership agreement which will prohibit the purchase by me or my family of any marketable securities. In other words, the new partnership will represent my entire investment operation in marketable securities so that my results will have to be directly proportional to yours, subject to the advantage I obtain if we do better than 6%. Oh, okay. So he's saying basically, if we do bad, I'm not going to give you any money from my own pocket,
Mm-hmm.
but know that I am not doing separate investments. About a sixth of the money that I'm investing with the partnership is my own damn money. So
Mm-hmm.
that's like, 15% or so, 15 to 20% is my own money.
Mm-hmm.
And yeah, so we're in the same boat. So if you lose, I lose too. So
Mm-hmm.
just deal with it.
Yeah.
D, a provision for monthly payments at the rate of 6% yearly based on beginning of the year capital valued at market. Uh, Partners not wishing to withdraw money currently can have this credited back to them automatically as an advance payment, drawing 6% to purchase an additional equity interest in the partnership at year end. This will solve one stumbling block that has heretofore existed in path of consolidation since many partners desire regular withdrawals and others wish to plow everything back. I think same thing. Like if at the year end you can have your money invested as stock equity in the partnership before that, you can have 6% monthly payments.
Yeah.
So
Mm-hmm.
more like a debt agreement until things get consolidated.
Mm-hmm.
Okay. The right to borrow during the year up to 20% of the value of your partnership interest at 6%. Such loans to be liquidated at year end or earlier. This will add a degree of liquidity to investment, which can now only be disposed of at year end. It is not intended that anything but relatively permanent funds to be invested in the partnerships, and we have no desire to turn it into a bank. Rather, I expect this to be a relatively unused provision which is available when something unexpected turns up and wait until year end to liquidate part of all of partners' interests would cause hardship. I think the same reverse is going to be true too. I mean, if you want to withdraw money
Mm-hmm.
up to 20% of the value of your partnership, you can do that by taking a loan. The partnership will give you a loan of about 6%
Mm-hmm.
interest.
Mm-hmm.
And so if you want some money in July, it's not year end, you can
Mm-hmm.
do that up to 20% of your partnership assets, and you have to give me 6% interest. And at the year end, you can sell that permanently and get your money back permanently, since that's when we're doing asset changes, permanent
Mm-hmm.
asset changes.
Mm-hmm.
But you should only be putting in money that you don't need. Don't put your life's, every penny,
Mm-hmm.
because you need to have some sort of buffer or emergency fund or whatever. Maintain that separately. This is
Mm-hmm.
not a bank. Don't put in money and remove money, month to month, year to year.
Yep.
So I discourage that.
And I guess really he doesn't want to incentivize people pulling out of his fund because it'll add more liquidity into his own allocation of money.
And he may
So
have to do forceful selling of assets he doesn't want to
yeah,
when that
yeah,
happens. So
yeah,
interesting. Last one, F, an arrangement whereby any relatively small tax adjustment made in later years on the partnership's return with the assets will be assessed directly to me. This way, we will not be faced with the problem of asking 80 people or more to amend their earlier return over some smaller matter as it stands now. A small change, such as division, that a dividend received by the partnership has 63% a return on capital instead of 68% could cause a multitude of paperwork. To prevent this, any change amounting to less than $1,000 of tax will be charged directly to me. I don't know. I think he's just saying,
yeah,
like, if there are small tax liabilities that are generating from the buying and the selling per partner, like, don't worry about it. The tax will just come to me because I don't want to do all the paperwork.
yeah. But if it's less than $1,000 of
Correct,
tax, yeah,
correct,
yeah,
correct.
that's not too much. Yeah.
That's still too much, man. Like, what the heck? I'm
I
sure it's
mean,
deducting it somehow. It's adjusting it in the back end. And like, screw you.
but yeah, hopefully he doesn't have that much. I mean, this is probably you know a rarity.
Yeah.
Yeah.
We have submitted the proposed agreement to Washington for a ruling that the merger would be tax free, and that the partnership would be treated as a partnership under the tax laws. While all this is a lot of work, it will make things enormously easier in the future. You might save this letter as a reference to read in conjunction with the agreement, which you will receive later in the year.
Okay, that's interesting. We've submitted the proposed agreement to Washington. I
I wish
mean,
I could be used that
that would
before.
be, yeah.
I am sending this to Washington.
Yeah, but
Say that
he
anymore.
that's to avoid really tax repercussions on that merger, right? So really, he's just saying, this should be tax free. It's still my asset
Yeah, because
here.
it's just
Not changing any.
restructuring. I
Yeah,
mean, it's not like
restructure.
he's selling everything and
Right.
buying it again. Because
Right.
when he's just saying, well, we just changing the paperwork, we
Yeah.
own what we.
Yeah. Yep.
The minimum investment for new partners is currently $25,000, but of course, this does not apply to present partners. Our method of operation will enable the partners to add or withdraw amount of any size in round 100 at year end. Um, Estimated total assets of the partnership will be in the neighborhood of $4 million, which enables us to consider investments such as the one mentioned earlier in this letter, which would have had to pass several years ago.
Okay.
This has turned out to be more of a production than my annual letter. If you have any questions, particularly regarding anything that isn't clear in my discussion of the new partnership agreement, be sure to let me know. If there are a large number of questions, I will write a supplemental letter to all partners giving the questions that arise and answers to them.
Yeah. Interesting. So, what's interesting about this is that if you wanted to be a partner in 1961 with Buffett, then you just would need $25,000.
That's a lot of money, man.
I mean, okay, let's talk about with adjusted for inflation and all that stuff. What would that be today?
I would say,
1961.
well, I would say it's probably 10x at least. No,
Ooh, really?
250,000.
You,
No,
you think so? I don't know. I don't know. Okay,
think
well,
about it. I mean, it was not because the Berkshire share would be like a $10 right now, probably, maybe $50,
yeah,
and that same share now is like almost half a million.
yeah, that's right. Okay,
So I mean, that's not inflation. That's someone who's compounding crazy amounts over a long period of time. But
yeah.
I don't think. I mean, today it will at least be 200,000.
Okay, I believe you, but yeah, then it kind of doesn't make sense. I was thinking 20,000. Okay, we can maybe drop that on Buffett. I'll trust him, but maybe that's not as simple.
In
Okay.
1960. I don't think a car. I mean, that's what you get. You can get a car today. I think back then a car was probably less than $1,000.
Oh, okay. All right. So we'd still be priced out of Buffett's partnerships. Interesting.
And for 25,000, you could probably buy a rocket, go to the moon.
That is what would happen if we invested in Buffett. We'd be going to the moon.
If you, well, maybe according to Answers.com, $100 from 1960 would be worth about $700 in 2005. That's not that crazy.
Yeah, that's not too bad. Can you? Is
In
there?
1960, a new house would cost $12,000,
Oof!
$15,000.
Wow.
So he's definitely asking for money that's a significant amount more than the price of a house.
Yeah, this is like maybe someone's life savings, or maybe really rich folks. This is kind of those are the
Yeah, I mean
partners.
price. Yeah, I mean it's not nothing.
Yeah, yeah,
Today, price of house is what, 400, 500 at least.
yeah, yeah. It's
Oh my
ridiculous. $1,000, golly! I should have just invested in a house back when I wasn't born.
God, that's why I don't think time machines exist.
Awesome. Well, that concludes the final letter of the 1960
Well,
year,
technically, this concludes
1961.
the first letter of 1961, and
Yep.
he talks more about his operation. He doesn't give us any investing
Yeah.
juicy details of. I mean,
Yeah.
I guess he's told us he bought something that um
should
because
not.
maybe
Yeah,
he would have passed on before, and it's from public market, we believe. He's buying stocks.
yeah. And he's not really like saying that it'll appreciate until a year. So a year after, then it might appreciate. That's what he's saying. So
Yeah.
he
So would you
he's
have
yeah.
invested your money after reading this letter?
That was exactly what I was going to ask you. That's so funny. I I wouldn't if first if I had that much money back in the day, I guess I'd already be killing it. So I don't
Yeah, I
know.
mean, I feel like,
It's
can
hard.
you invest? Like,
Yeah,
I mean,
exactly.
you stress this question, and now we're like, well, do we even qualify?
We definitely
It's
don't
not a would we give
qualify.
him money? Will he accept our money? I'm like, nah, who are you? Get out of here.
Well, the interesting thing here is that even at that time, he was priced out. I mean, most people would be priced out. Other like all the time in the news, you hear about, hey, if you invested only $1,000 in Buffett, now you'd be a millionaire or whatever. It's like, well, you couldn't have even bought in at that time because you weren't even
Very
allowed. It's not even
true.
public, so it's not
If you
like you
had a
could.
house,
Yeah,
if you had money for one and a half house just
yeah,
laying around, you could buy a house, or you could be like, meh, I'll give this is a random dude who has a letter, and his last name is his type of food arrangement.
yeah. But I mean, looking at how he's allocated capital for the past 5 years, I would say that he's outperformed the market. So he's got a good track record. But 5 years, even for him, he admits it. It's not that long. So I mean, if I had it lying around, and I think I would, wouldn't you?
I mean, now he has a track record, and now he's explaining of how he's investing. So I can understand that it's not, like just mumbo jumbo or just
Yeah,
witchcraft that he's doing, or
yeah,
he's not selling Tupperware. And
yeah.
I mean, things what he's doing is makes sense. I don't know how I feel about activist investors, but
Yeah, actually, I kind of have to think about it as well because, one, we don't know what his investments are. A lot of it is private. And then just because he's shown us the percentage of his actualized gains, it shouldn't be the real incentive. So I would be actually a bad investor if I invested at this time because I don't know all the details of what goes into the investment. So,
mm,
you know,
yeah. And I mean, we have had frauds, big frauds, where people don't tell you what they're investing in,
yeah.
and they cite, well, I don't want the competition. So, but I'll tell you how much I'm returning, and when you need the money, I'll give you your money when
Yeah.
you want to pull out. And that's how Ponzi schemes get created.
Yeah, that like Bernie
Yeah,
Madoff comes to mind.
yeah,
Yeah, yeah,
yeah. It's
yeah,
exactly. I mean, it's a high flyer, big name
yeah,
in financial industry, and
yeah.
still, it was all a mirage. And I mean, at this point, that would be one of my concerns. Like, okay, how can I trust this Buffett dude? Really?
That's right. That's right. Yeah, and 31 years old. Keep in mind, you gotta
Yeah,
like
like
at least like Madoff had gray hair, and you know he seemed more
exactly.
trustworthy. Yeah. Okay, so it's a no investment from the both of us, as though we had that money.
Well, it's partly because of the money, and partly because he wouldn't talk to us.
That's right. That's right.
Yeah.
Yeah. Well, that concludes 1961's Part 1 letter,
Yes.
or 1960
Yes.
Part 2. Yep.
All
Awesome.
right.
See you in the
Over and
next
out.
one.